Are you looking for a great stock pick? Can I interest you in a 6x return? What about a 14x return? Not good enough? What about a 19x return? Is this a crypto Ponzi scheme? No, it's Cathie Wood's latest Zoom valuation. At $100 a share, Cathie Wood has a 2026 price target for Zoom of $700, $1,500, and $2,000 for her bear, neutral, and bull thesis. $2,000 a share in 5 years, you think? What could go wrong? Today, we dive into Cathie Wood's Zoom valuation. I am specifically responding to the comments made by her company in their Zoom valuation podcast. Is Zoom the next Tesla 20-bagger, or is it another forgotten Wall Street bets meme stock that crashes into oblivion, never to be talked about again? I'm going to go over 4 things in this video. What Zoom is, why Ark Invested, why I think Ark's investment thesis is weak, and what my valuation for Zoom is. During the course of this video, I will also make a bombshell revelation regarding Zoom, artificial intelligence, and data security. What is Zoom? Communication has been a staple of the internet. However, video and voice communication was always too data intensive, so we relied on text. As compression algorithms got better, voice was included, but it wasn't until Skype that video chat became mainstream. Skype's success drew the interest of Microsoft, who acquired it in 2011. After being in Microsoft's portfolio, Skype languished. Skype had poor video quality and connection. Other video services like WebEx weren't much better. Then the pandemic hit, and people found out about Zoom. Despite being founded in 2011 when Microsoft acquired Skype, the company was very little known. However, Zoom's key differentiator was a better video compression algorithm that handled poor internet quality better, as well as being built from the ground up as a cloud video chat service. Zoom's catalyst for growth was the pandemic. People were forced to work from home, and Zoom's user numbers skyrocketed, leading it to be one of the dominant video chat platforms today. Why did Ark invest? Having a great video platform is one thing, but why did Ark invest? First, since 2019, Zoom has been profitable. Furthermore, Ark liked the culture, the hires, artificial intelligence applications, the move to hybrid work, and the product's superior performance. Addressing the culture and hires first, Ark mentioned how they had met with senior management and felt the company had good culture. Additionally, the company had key hires from other companies. The CEO of Zoom is all in on the product and has utilized the product to keep his business travel to a minimum. As part of the CEO's founding mythology, this allows him to fulfill a promise to his wife to keep his business travel to 2 trips a year. Moving on to artificial intelligence applications, Ark discusses how Zoom will be able to add more value through artificial intelligence applications. Imagine an artificial intelligence that takes notes on the meeting you are in, then schedules a follow-up meeting if necessary. As well, the artificial intelligence could create key action points and follow up later to see if these were addressed. Ark also discusses how the move to hybrid work will cause increasing demand for Zoom's product. The pandemic spurred a move to hybrid work, and this move has only continued as workers realize they can be just as productive at home as in the office. Additionally, the nature of work has changed, as the work we do is more globalized and thus will require more video communication. Finally, Ark believes the product itself is superior. Most people at this point would probably think of Zoom as the best consumer-facing video application. While WebEx and Skype are options, these options have never taken off in the general public as much as Zoom has today. Zoom's video compression algorithm has definitely differentiated the product. Additionally, the beauty filters of Zoom do not hurt. as people are more likely to be on camera when they feel they look good. Reviewing Ark's thesis. With this understanding of Ark's investment thesis in mind, let's review Ark's key points. These were the culture, the hires, artificial intelligence applications, the move to hybrid work, and the product's superior performance. Starting with the culture and hires, one has to have a significant advantage here to make it a part of your investment thesis. Citing ex-Google employees as a reason for investing is extremely weak, which is a charitable way of saying it is not a reason at all. Big tech has hundreds of executives and thousands of former executives. Not every Google executive goes on to be relevant. Similarly, a great culture is just buzzwords. I was disappointed this was given any mention, as it really is just filler. If their thesis was concise, say so, but filler only dilutes their actual key points. Moving on to artificial intelligence, first I'll address the good. Zoom intends to leverage artificial intelligence to help with all aspects. It helps with the custom backgrounds, the video compression, the audio quality, transcripts, etc. They would like for it to help with meeting notes, action takeaways, and future meeting schedules. I think we can all agree this would be valuable and would help make management's job easier. It would also remove the need for a dedicated note taker. It would add value, and the companies would certainly be willing to pay a premium for this. I do agree, if this could work, it's a great idea. Now, the bad. This falls apart very quickly, however, when you probe any deeper than the surface level mentioned. Meeting notes have actually been tackled, and I do believe this will be offered, if it isn't already. But future meeting schedules? Action takeaways? This sounds feasible if you don't understand how artificial intelligence works. However, artificial intelligence needs a lot of data inputs to train it. There is little data for it to know if a future meeting should be scheduled, as that will require current interaction with the product that hasn't occurred. This isn't mining old data, which is how artificial intelligence models are developed. It is interacting with something to generate new data to then train a model. Keeping this simple, the data isn't there yet to train these models. The bombshell. Now, for the bombshell revelation. Where does the data come from to train these models? Your calls. In order for Zoom to train a model, it needs to continually collect data from your calls and analyze them. Multiple times during this podcast, it is mentioned that Zoom utilizes your data to train its model.
So the other sort of top-down work we did related to Zoom is AI productivity.
Assuming the successful rollout and adoption of AI products as the recently announced.
But just to touch on the AI opportunity, I'll start.
I think as the world becomes increasingly aware of how much of their data is being collected to train artificial intelligence models and how much private data they are giving up, they will not be pleased. There is a reason Zoom has a free version. If you are not paying for the product, you are the product. Moving away from the dystopian horrors of artificial intelligence, we have remote work. I wasn't sure the exact numbers she was forecasting, but I came across her work paper, which I will dig into depth further in a future video. For now, I will pull the most relevant slide to continue. She concludes that there are 400 million hybrid workers now, but that there are 800 million hybrid workers in the next 5 years. That's a huge surge, and I think she is highly optimistic on our ability to shift how we work. Humans have worked in person effectively for centuries, and while we have been productive during this time, I don't believe business leaders will continue to let this situation last. According to this survey by McKinsey, 50% of business leaders believe that work will be done at least 50% in the office, with 10% of business leaders thinking 80% of work will be in the office. However, I believe they are currently telling employees what they want to hear. As labor shortages subside, employers will be happy to mandate a return to the office. She is forecasting a 15% a year growth in hybrid work, which, unless there is a large catalyst, I do not believe employers are willing to give. During the height of the pandemic, all jobs that could be done remotely were. I don't believe double the amount of jobs were out there and that we just didn't do them remotely and went to work when they were non-essential, or that these businesses just didn't operate for a long period of time. This does not pass the common sense test. Despite all of this, any growth in hybrid work would be huge for Zoom, as capturing any small portion of this is hugely beneficial for Zoom due to Zoom's high gross margin. Being highly conservative, I will be using a 2 to 3% a year growth rate for hybrid work over the next 5 years. We now get to the product itself. Zoom is a good product. The video quality is good, the audio quality is great, the product just works. There is no question Zoom is a good product. The question is whether Zoom is the right product. With the main issue being product fit, who does Zoom fit? Business customers or consumers? With business customers, Zoom goes up against Teams. Microsoft has a huge advantage with Teams, as Teams is on every Windows computer by default. The additional cost to your company is minimal, and you are most likely already paying for it. It was why I recommended it for the company I work for, as we were already paying for the service. This causes an inherent issue for Zoom, as Teams will be the default choice for most people. When compared to Zoom, Teams' audio and video quality is good enough. With consumers, Zoom does not have a hangout feel, which is critical for messaging apps to take off. While people do meet up for family events on Zoom, Zoom is still not the preferred method for people to hang out. I would currently give this reward to Discord. Discord has a massive group of users. Also, calls and video through Discord work well. The ability to hang out and see who is available is important. Zoom would need to develop something similar to Discord for me to feel confident about them in the consumer realm. A merger between the two would be a match made in heaven. With Discord looming large in the consumer realm and the threat of the launch of a non-gamer focused Discord being on the horizon, I currently can't add much value to the consumer paying portion side of Zoom. The valuation. Having covered the company and its drivers of revenue and value, we are ready to attempt to model the future revenues and profitability. Zoom is a company that I think has a lot of unknowns, so the first place I am going to start is with a back of the hand calculation. This back of the hand calculation is based off of the price to earnings ratio of Zoom. If Zoom were to grow earnings by 15%, would they be a worthwhile company or would they be overvalued? I chose 15% for this back of the hand calculation, as most growth companies can hit such a number. But if a company is wildly overvalued with a 15% earnings growth rate and there is no confidence in deriving a higher growth rate, it is best to simply avoid the stock and see how it plays out. Here we can see that with a 15% earnings growth rate, the company would be a decent investment with a 14.5% annualized return and a 16% margin of safety. It is 107 today, and our model shows it to be worth 124. Keeping in mind that this is a purely back-of-the-hand calculation, let's dive deeper. Going into our deeper model, I am going to forecast 3 scenarios: a bull case, neutral case, and bear case. With the bull case, I will accept the scenario that hybrid work will grow. However, 15% user growth seems to me to be insanity. Given Zoom's recent growth of 10% year over year and stagnant quarter over quarter growth, I will hesitantly give Zoom a 10% revenue growth rate. This is comprised of 2 to 3% user growth a year, with price increases and new products making up the remainder of the growth. As Zoom's gross margins have been improving and the company forecasts 76 to 80% future margins, in this model, I will have the cost of goods sold grow at half that of revenue at 5% for the first 5 years. This will give Zoom a gross margin of 80% by the end of year 5. After this, the cost of goods sold will grow in lockstep with revenues. For selling, general, and admin expenses, I have this growing in line with revenue, and the R&D I have growing in line with revenue as well. The company would like to spend 10% of its revenue on R&D, and this is relatively in line with the company's forecast. With these inputs in mind, the company's internal rate of return is approximately 9.5% a year. These inputs show the company is overvalued. However, I think this bull case is highly improbable. When digging into this subject, the data I have seen suggested that hybrid work will remain stagnant or even decline. In a neutral stagnant case, I will have revenue growing at 5% a year, with cost of goods sold growing at 2.5% for the first 5 years before increasing to 5% a year in line with revenue. I will also have sales admin costs growing at 5% and R&D will be 10% of revenues. This will represent a mostly stagnant user base with increases in price for new value added. This leads to a 4% internal rate of return. This is quite low and our valuation shows this. This scenario shows a 50% decline in share price. I had intended to show a bear case. However, I think with a 50% downside in our neutral projection, we can see that a bearish projection will obviously be far worse. Our projections differ vastly from Cathie. Like my previous video, I believe Ark Invest is too bullish on their thesis and does not adequately factor in risks. Reviewing this Gallup survey article, we can see just how likely a neutral or negative scenario is. Pre-pandemic, we were already 32% hybrid. By February 2022, on-site work declined 41 points, with 10 points being picked up by hybrid, and the remaining going to exclusively remote. However, the anticipation of workers is that on-site work will return up 4 points, and fully exclusive work will be reduced as well. Despite workers wanting to work remotely, they expect to return to the workplace more. This means Zoom faces significant headwinds. I do not believe there will be a significant reduction in usage of online tools, as we all still need the ability to communicate externally with people. I also don't believe there will be a huge increase in usage of these tools over the next 5 years. Certainly not the doubling of people Cathie predicts. As the world was locked down for an extended period of time, it is hard to believe that 400 million workers who could have worked remotely did not and took a few-month vacation before returning to work. Integrating the next sets of online workers will be more challenging than the initial set, let alone an additional 400 million workers. Microsoft is a great example of forecasted growth not coming to fruition. Microsoft forecasted large growth when they originally acquired Skype. They expected to ride the wave of growth in online voice communications, yet Skype has more or less been stagnant for years, despite the growth in online communications. Discord, FaceTime, Google whatever, since they change their name all the time, and WhatsApp all came into this space and provided competition, limiting Microsoft's growth ambitions. As I started recording this script, Snapchat announced video chat features similar to Zoom and has had basic video chat features for a while, further eroding my confidence in the outlook for Zoom. With Zoom itself only projecting 11% revenue growth for 2023, I do not see a pathway to this being a profitable investment at this current price. I would want to see the price down at least 30% or net income and revenue significantly up before I am interested in reviewing this again. Wrap up. Considering how unlikely the bull scenario is and how negative the neutral and bear cases are for Zoom, it is my personal opinion to avoid this stock. It is quite rare that I stop mid-valuation, but there is just not enough evidence hybrid work will increase and that Zoom will capture it. With pressure to return to the office and pressure from companies to onshore their workforce, Zoom no longer has a large tailwind behind it. With that said, if you do believe Cathie and you believe Zoom can grow earnings by 15% or greater a year, Zoom is a decent investment based off of my back of the hand model. Zoom projects that more than 10% of its revenue will come from new products by 2025. That would be significant growth compared to the deceleration Zoom has currently experienced. However, my confidence that Zoom will be able to achieve such a growth rate through new product launches is extremely low. That's it for me on Zoom. If this was useful, leave a like and a comment. And if it was not, let me know where you disagree. Bye.